we'll go ahead and get started. Thanks for joining us today. We're excited to welcome back Phil Argue, who is the Director of Investment Strategy with SIA, familiar face around here. Phil is going to provide a Q2 performance recap and review some areas of opportunity for the coming months ahead. Phil, thanks for joining us again.
It's my pleasure. Thank you for having me.
Thanks, Phil. Appreciate it.
Yes, you want me to just dive right in or
Yeah, let's rock and roll.
okay.
Give folks what they want.
Well, so I've got a number of slides as normal. But so I figure I would just kind of maybe set the stage a little bit here. I mean, we've been in an environment where, equity markets have had an extremely good run. So if you go back to 2023, we were up 25%. 2024, we were up 24%. Last year we were up 18, and this year, first half of the year we're up about 10% or so on the S&P. Um, and so there's been a couple of tailwinds that have been at our back recently that we're probably at the peak of. And we'll get into those here. Let me share my screen so we can get into these slides. Uh, Carl, you got this? Am I sharing the right one?
Yep.
Got it.
Investment
Okay.
day July. Yep.
Okay. So the big story for the first half of the year was, is this economic reacceleration real? And the reality is it's been real for some parts of the economy, but importantly, it's certainly been real for corporate earnings, which has certainly powered, the stock market. We'll get into all of that. Um, there's been a couple of serious policy tailwinds, which we'll get into. But those policy tailwinds we might be at their peak. We got a new sheriff in town at the Fed. So we've got Kevin Warsh just took over, really last month, and he's threatening to make some changes with monetary policy, which could be something that's going to affect things going forward. Ironically, usually the best of times pave the way for worse times, which we'll get into. So usually when corporate earnings are as good as they are, it's probably a good time to start reining in your expectations for the future. So we'll talk about that. We've also seen some extreme divergences within markets and across markets, which we'll touch on. And then we'll talk a little bit about we'll kind of frame what we think the big questions are for the second half of the year. And we can go off script. Folks have questions. Carl, you want to interrupt me and say, "Hey, let's talk about this other thing." By all means, this isn't, we're not set in stone here. So, um, when I mentioned the first half of the year, the big question was, "Hey, is this reacceleration real?" And we had this diagram. Carl, I might have shown this one the last time that we spoke. I think back in February or whatnot. But so we had been in this environment. So on the left-hand side here is GDP growth. The number that we see in the news when they report it is the blue line. So the most recent reading, 2.1% GDP growth. That was for the first quarter. The one that actually matters is one that they don't publish is the gray line. It's nominal GDP growth. So that's if you just add up the dollar amount of all the goods, produced in the US. That is a really good correlation to top line earnings growth for corporations. So it kind of tells you what sales growth is going to be for corporations. And obviously, when sales are going up, earnings are going up. And so that's kind of what we want to look at. And so we kind of created this little diagram. This was our mental model for the first half of the year was if nominal GDP growth is up here 6% or so, you want to own cyclical type stocks. You want to own banks. You want to own trucking companies, things of that sort. When growth is slow, down here in, let's say, 3 to 5%, it's these mega cap growth names that tend to do well because Google's going to grow earnings at 20%, whether the economy is growing at 3 or 6, they can grow regardless, right? So money tends to flow that way. And so what we've seen is that in the first half of the year, while economic growth hasn't actually been that strong, certainly corporate earnings have certainly favored more of the cyclical areas. And so what's happened over the first half of the year is we've actually seen an increase in manufacturing activity. So this is the ISM manufacturing survey, and it goes out to all the purchasing managers at all of these large corporations, and they ask, the head of procurement at Ford, "Hey, are you buying more steel to build more F-150s?" And so when this number is going up, that is increased activity. Yes, new orders are higher. Our manufacturing activity is increasing. And we were in an environment here between 2022 and the end of 2025. This was the longest manufacturing slump going back to the 1950s. So we're emerging from that, and so some cyclical areas of the economy are doing better. We've also seen a bounce in more service-oriented industries, so things are improving there as well. So backdrop was largely positive for corporate activity. And we also saw some bright spots in the labor market. So headline job growth. So on the left-hand side, the gray little bars here are the monthly non-farm payroll report. We get the first Friday of every month. The blue line is the 3-month average. Now, historically, when the 3-month average goes negative, it's usually a real warning sign. Like we've got some problems in the economy. And what we saw at the beginning of the year is all of a sudden it started to shoot higher, right? We started to see increased job growth, which is a big positive. So again, more constructive on the economy. And then on the right-hand side, we're tracking weekly jobless claims. So every time that somebody unfortunately loses their job, they file for unemployment insurance. Every state aggregates all of those numbers and publishes them. And so the weekly jobless claims is the gray lines here. And so obviously with this big jolt up here is COVID. So if we were to go back to like 2008, you'd see not as severe, but a significant rise up. The blue line is continuing claims. Hey, you've already submitted for unemployment insurance. You're still on unemployment. And what you'll notice is these lines have been going down. And so fewer and fewer people are relying on unemployment insurance, which again is a positive thing. But the labor market is very bifurcated. And so on this graph here, on the left-hand side, there are 250 industries that the Bureau of Labor Statistics tracks when they do their the jobs report. And this is this is the percentage of industries of those 250 that have added jobs over the last 3 months. Okay. And so it's just call it 54%. So that means 46% of industries have shed jobs over the last 3 months. Okay. And if we look at the year over year change in job growth in the US in this table in the bottom left over here. So over the last year, we've added about 500,000 jobs, 503,000. If we just looked at healthcare jobs, they've added 645,000. So all the job growth is really been in one industry, nursing, hospitals, elder care, things of that sort. For Carl and Mary and I put financial activities over here. We're one of the ones that are contracting. So what is that? Minus 82,000. So anyway, but the story is we have this secular tailwind in the labor market that is the healthcare industry. And obviously we know baby boomers getting older, more folks relying on more healthcare services. And that's really what's been the driving force behind the labor market. Everything else has been pretty notably weak, although we're starting to see a little bit of improvement. Certainly not, boom times back like 2021 or, the mid 2010s, but still we're moving in the right direction. So while maybe labor market dynamics don't feel great outside of healthcare, there are some tepid signs that things are improving. But maybe it's not quite as good as what this headline number suggests. So some dynamics under the hood there. Obviously, the labor market's important because it's still, as much as everybody talks about AI and data centers and all this and that, consumption is still 70% of the economy, and so it's a big driver. So
would you consider that healthcare boom to continue into the future? Obviously continued. So it's more or less become more of a norm. Is that the expectation?
Yes, and I think the good thing about that. So it's just a byproduct of demographics, right? As our population gets older, people are living longer. So I don't think that's a trend that's going to change. And the one benefit of that is healthcare jobs are not cyclical, right? Housing, construction jobs, those are cyclical. Healthcare is always very stable. And so this does provide, a strong ballast for the labor market. Doesn't mean that we can't have negative job growth if other areas are, poor, but we're definitely better off having this than not having it. That's for sure. Yeah. Um, so another measure of importantly for policymakers and Kevin Warsh, our new Fed chairman, which we'll talk about in a little bit here, probably the best gauge of tightness or slack in the labor market is wage growth, right? If there are a bunch of job openings and we can't hire people, hey, maybe we have to raise wages to entice people to come work for us. What we're not, even though we're seeing some increase in the number of jobs created, wage growth, so this is year over year wage growth at, what is that, 3.6%, is really the lowest it's been, since COVID. So even though we're seeing some lift in nominal job growth, the number of people that are working, it's not translating into faster wage growth at the moment, which is a sign that it's still tepid, right? We're not booming in the labor market. And a little bit of the challenge here, in part due to the Strait of Hormuz, but also because the Fed has been reluctant to get inflation back to 2%. We've got elevated levels of inflation. We're at 3.5% on headline inflation year over year. So there's negative wage growth. It doesn't feel like people are getting ahead, right? The cost of living is going up about as much as my wages. It doesn't feel good. Now, initially, this little spike here is just the war in Iran. Yesterday, we had a really good inflation reading, a very soft inflation reading, which was very positive. But then again, last weekend we started shooting again, and the Strait of Hormuz is closed again. So it's a dynamic situation. But moral of the story, the labor market is trying to improve, but it's not great. Where most of the improvement has been really with corporations. And for investors' sake, that's something we care about, obviously, greatly. So, what are these policy tailwinds that are at our back? So, on the left-hand side here, so the Treasury Department is great with providing. They tell you where every penny goes. Dollars coming in, dollars going out. And so we had a big tax bill last year. The one big beautiful bill was signed on the 4th of July. And so we took May's monthly treasury statement and just looked at, hey, what was the change in tax revenue coming into the Treasury Department from various sources. So if we took all tax receipts, they were up 7.4%. Okay. Personal income taxes were 4.5%, up 4.5%. But if you look at what happened to corporate taxes went down by almost 30%. And the big part of this is a component of the one big beautiful bill that allows corporations to expense or to accelerate the depreciation on capital expenditures. So if General Motors wants to go build a new factory, normally they'd go spend $1 billion, build a new factory, and they would depreciate it over time. And you would take, let's say, maybe that factory's life is 30 years. You would take 1/30th of the cost of building that and you'd write it off as an expense that year. Starting last year, it allowed companies to take the full cost. So General Motors builds this $1 billion factory. They can write that $1 billion off against their taxes. Okay. And that's what companies are doing. So huge tailwind to corporate earnings. And for individuals, if you looked at tax refunds, we did no tax on tips, no tax on overtime, an enhanced senior deduction, and so as a result, tax refunds at the end of the year were up, call it 17% year over year. So all of a sudden in April, everybody had a little extra cash in their pocket. Some of that was offset by higher gas prices, but corporations have got the big boost. Okay. On the other hand, on the other side of the chart, we've got the monthly dollar amount that came into the Treasury Department via tariffs. Okay. And you may remember several months ago, the Supreme Court struck down the tariffs and said they were unlawful, and Trump's got to figure out another avenue to put the tariffs on. And so obviously we had this huge run up in tariffs last year when Trump announced all of them. We got up to, call it $30 billion a month that we were bringing in. Certainly revenue that the Treasury Department needs because we're running huge deficits. But then as these things got reversed, there's about $160 billion that needs to go back out to everybody. And now it's just starting. So you'd see last month we sent out about 24 billion that went back to corporations. Some of it goes to individuals, sure. But I had to replace a dishwasher, 3 months ago. Whirlpool is not going to send me a refund for the tariff amount, right? The Whirlpool is going to keep that money, and that goes to their profit. So this is another tailwind in addition to the tax cuts that are certainly going to continue helping corporate earnings, at least for the short term here. So tax policy, super positive for corporations, obviously with the tax cuts. Inadvertently, the tariff policy is now becoming a big tailwind as we're sending all this money back out to corporations. And then the other policy tailwind that we've had, that we've enjoyed, that might be changing is the Fed chair, or the Federal Reserve. So the chart in the top right corner, if we just look at this one to start with, this is the Fed's own measure of financial conditions. And so when we're below zero, that means financial conditions are accommodative, that they're helping the economy grow faster. When they're above that horizontal axis or above zero, financial conditions are tight, okay? And that they're putting downward pressure on the economy, trying to contain inflation. And what you'll notice is, I mean, this is a 10-year chart. We have not had tight monetary policy hardly at all for the last 10 years. Really, 2022, a little bit there when the Fed had to raise rates aggressively. We just barely got up there to sort of tight monetary policy. Certainly during COVID, there was a whole lot of distortions that happened there. But Kevin Warsh is talking about pushing this line higher and maybe tightening financial conditions to try and get inflation under control. It's been 5 years since the Fed has hit their 2% inflation target. And Kevin Warsh is saying, hey, that's unacceptable. Every time he comes out and speaks, he says, like, hey, we're going to get back to this 2% target. And that's one of the big questions for the second half of the year is, hey, does he want to get back to 2%, next year or in November, right? And the difference there is, hey, how aggressive do they have to raise rates to contain things? The other thing is, the Fed still has an enormous balance sheet, $6.7 trillion that they have of treasuries and mortgages. And the balance sheet's actually going up a little bit over the last few months. And Kevin Warsh has in his confirmation hearing, noted that in his view, the use of the balance sheet exaggerates inequality because it benefits those people with financial assets, because what we're doing is juicing the market to try and produce a wealth effect that it helps people go spend. But those people who don't have assets don't benefit from that. So that's a policy that exacerbates inequality. The challenge with this is he's also not a fan of forward guidance. So with Jay Powell and Yellen before him and Bernanke before her, they were all very big advocates of telling the market what they were going to do 6 months before they would do it. So the market would easily be able to price in, any change in the Fed's policy. Kevin Warsh is not a fan of that. He would much rather go back to the Alan Greenspan days where, there was no press conference, there was no statement, and people were guessing, is Greenspan going to raise rates or lower rates based on, the stack of papers he was, carrying into the Fed's office back in the day. So it's going to be a challenge to get a read on which way, he's steering the Fed, because he's going to communicate much less. Other thing is, he also doesn't believe our current inflation measures are effective. And I think everybody would agree, like, I don't know, is the cost of living gone up 3%, over the last year? I don't know. A lot of people could argue that the cost of living has gone up much faster than what the official metrics are. He's put together a task force to figure out, maybe a better way of doing that. And then the last thing, he is a big believer that AI is going to be deflationary. So we're going to get enhanced productivity. Costs should come down. And that's the path to where we get rate cuts eventually. But we first have to get over this little inflation problem to begin with. Now, why is this important? So bear with me for a second. Let me explain what this chart is, and then hopefully it makes sense. So the blue line here is the difference between the yield on a 2-year treasury bond versus a 3-month treasury bond, okay? And sometimes this number is elevated up here. Sometimes it's very low. And what that is showing you is it's the treasury market pricing in, is the Fed going to be raising rates over the next 2 years, or are they going to be cutting rates over the next 2 years? And the stark example here is in 2021, the treasury market started to price in the probability that the Fed's going to have to raise rates. This line starts to go higher, meaning 2-year treasury yields go up because people are expecting, hey, the Fed's going to have to raise rates. And that's a negative for the stock market. The red line here is the drawdown of the S&P 500. So that's the percent off of its all-time high. 2022, we had a 20+% drawdown. And it was all due to, hey, the Fed having to raise rates. And what you'll notice over here on the right-hand side, this ratio is now perking up again, as the market is expecting, hey, maybe this guy is serious. He's gonna potentially raise rates. So every inflation reading is important. Everything that Kevin Warsh kind of comes out and says is certainly important. He's testifying ahead of in front of Congress yesterday and today. I've got a team member who's listening to his every word, so we're trying to better understand which way he's going. So that's going to be a big factor. What does Kevin Warsh do in terms of getting inflation under control? But it's not just Kevin Warsh. Central banks around the world are starting to raise rates as well. So the ECB has raised rates last month. Japan has been on a hiking cycle for a while. Norway has started to hike rates. So it's not just a U.S. thing. Obviously, the issue with the Strait of Hormuz and elevated energy prices is affecting everybody. And so central banks, around the world are saying, hey, you should raise rates. Now, this gets a little technical, but there is this shorthand metric that central bankers use that if you wanted to just say, hey, like, where should policy rates be at any given time? They created this, what they call the Taylor rule. And it just takes the level of economic growth and the level of inflation, and it says, hey, if you wanted to get those back to target, where should policy rates be? And so, based on the Taylor rule, just with where rates are, where inflation is and growth, the Taylor rule says the Fed should be at 6.6%, right? 300 basis points higher from where it is now. Now that's based on current inflation, and if inflation comes down with oil prices, obviously we're not going to jump to that. But some of these other central banks are offsides as well, and they are deciding to get moving. They're not waiting. So this is probably going to be a theme that we're going to see going forward. It's not necessarily always a bad thing, as long as corporate earnings are doing well. We can certainly handle a rate hiking cycle without everything falling apart. But this will be an interesting dynamic to follow. So,
what level of interchange do you think there is there? So, we're at 375. When do you start to feel the pressure? Are we talking, we could probably manage another half point rate increase, but you start to go a point higher, that could be a dramatic difference. How is the market thinking about that?
So that is a great question, and that's one that, unfortunately, I don't think anybody has the answer to. Well, look, I will say if the Fed raises rates, well, at this point, I would say that they're all going to be negative for financial markets in the short term.
Yep.
The economy, though, can certainly handle higher rates. The stock market has kind of been lulled by this 10-year period of very accommodative policy. So like any interest rate increases are going to be a headwind. But what I'll show you in a few minutes is earnings growth is exceptional. So I don't think I wouldn't say that, hey, there's a level where, hey, it becomes a problem. It's gradual, and I would say it goes. There's sort of an exponential slope to it. So if they raise 25 basis points and stop, no big deal. That's already priced into the market for the most part. If they come out and they're going to do 75 basis points, over the next year, all right, that's going to start to be a headwind. And if they get real serious, then yeah, it becomes more of a problem. But unfortunately, I don't think there's like a level where you could say, hey, if we get past 4.25, the sky's falling. yeah, I think there's a lot more other variables that are kind of at play there. On the other hand, let me mention this. So, like I mentioned, earnings have been exceptional. Tax cuts, tariff refunds, manufacturing improving. And so this chart, you might have to kind of squint a little bit here, but what we're looking at is the year-over-year change in earnings for the S&P 500, which is in red, okay? The tech sector, which is in gray, if you can see it there, and then the semiconductor industry, which is in blue. And Carl, to your question about what level of rates, so I actually, at one of Kevin Warsh's his first FOMC press conference, one of the reporters asked him, hey, do you think your policy is restrictive? And he said something to the effect of, when I look around the economy, I could say that our policy is restrictive on housing, but nothing else. Meaning, okay, housing market obviously sensitive to interest rates, but if you look across any other industry, the economy, at least, certainly the economy, certainly corporate earnings are booming. And I mean, here's a picture of it. So, I mean, earnings growth for the semiconductor industry, and we all know what's going on with AI. We'll talk about it in a minute. Earnings are up 200% year over year. The tech sector is up, call it 65% or so. And we just started earnings season earlier this week for the second quarter, and we're going to post 20% earnings growth year over year for the S&P. So while the Fed has got to set policy for the overall economy, including housing and everything else, the fact is a lot of industries are just not interest rate sensitive. Whether the Fed raises rates 100 basis points or 200 basis points, NVIDIA is still going to produce the same number of chips. It's not going to slow down, some of this data center construction that's going on. So earnings are extremely strong. However, strong earnings growth doesn't necessarily translate to great earnings growth going forward. This is counterintuitive. But so this is the S&P earnings growth going back to 2005, okay? And then the blue line is the forward one-year return for the S&P 500. And it's kind of counterintuitive, but what you'll notice is that when earnings growth is extremely weak, two standard deviations, so figure this is like, the fifth percentile, right? Extremely low, earnings growth, or in this case, it would be earnings contractions, is where we see the best returns, right? And that's usually because the stock market has taken a huge plunge. And that's usually the time where earnings are best. When we get to these sort of high points where earnings growth is extremely strong, we tend to have pulled forward a lot of demand for equities. Hey, there's all this great news. There's no reason not to buy. Semiconductors are taking off and everybody buys, pushing stock prices higher. And then inevitably, earnings growth can't maintain that pace. There's a natural ebb and flow in the economy. And then earnings, naturally, when earnings are that strong, we tend to get some disappointment. I don't know that we're quite there yet. This will be a story for the second half of the year. And this isn't hey, we got to go batten down the hatches next month or anything. But it's something to monitor. Even though, you're going to hear companies announcing record-breaking earnings over the next, 6 weeks, that doesn't necessarily mean, things are great going forward. In fact, it's kind of the opposite. So this is another way of kind of looking at it. This is the same data on this graph on the right-hand side, where we have year-over-year change in earnings on the horizontal axis, and then this is the one-year forward return, and you can see there is a negative relationship there. It seems, like I said, counterintuitive. The best returns are when company earnings are falling apart. It's usually because the stock market's down. So something to keep an eye on. All of these dots down here in this data set are 21 and 22. It's important because, again, remember going back to Kevin Warsh, if he comes out saying, hey, we're going to raise rates, that's what happened in 21 and 22. So that's why we're keeping a close eye on that. So
I have a question for you then.
Yeah.
You obviously highlighted the growth in semiconductors. I mean, can NVIDIA continue to do what they're doing, every single quarter? And obviously there's such a big component, when you're thinking about just like the S&P and the overall returns that, most investors lean into. Um, I mean, this is that like an area that really concerns you the most? Because if they pull back whatsoever, from these levels, I mean, it's hard for the call it the market and the S&P to really deliver any return.
So, uh, well, so yes, it will be a headwind. And actually, so this is where I'm actually my slides are going. So let's talk about semiconductors because here's a couple of charts for you. So on the left-hand side is the year-over-year change for the semiconductor industry group versus the S&P 500. So over the last 12 months, they've outperformed by call it 135% or so. Um, and the semiconductor industry group has gotten much, much larger. It used to be, a 5% weight in the S&P. It's now something like 18%. But uh, to your point, Carl, the returns have not been from who you think, who the most people would think. You mentioned Nvidia is obviously the household name that everybody knows. Um, Maybe this week's a little different, but Nvidia is up like 8% year to date. It's
Like
really
Micron,
been these
maybe a Micron then.
okay, well, okay, Micron, right? Okay, Micron is right. It's really everything that's been tied to storage and memory. So, best performing stock this year is a company called SanDisk. Western Digital is another one that's been great. Seagate Technology. These are all companies that make either hard drives or memory, and that is the current bottleneck um, within this whole AI infrastructure build out. Uh, History would tell you this isn't going to last. That doesn't mean it's bad for the stock market. It just means we're likely to see a huge rotation between winners and losers. So what this chart goes back to 2011. So this is a 15-year chart. This is now think of tech. Semiconductors are now about half of the tech sector. This is semiconductors versus tech. Instead of on the left-hand side, it was versus the S&P, big broad index. This is just, hey, all tech stocks. It's still, outperforming even tech by 120%. And so what we've seen is there is this huge divergence, not just, hey, semis versus, everything else, oh, that's the most extreme. It's also even within technology. So this is looking at each sector, and we're looking at the top quintile group of stocks, best performers, so top 20% versus the bottom 20%. Um, and you can see what in tech, the spread between those two is 174%. And so what I think you likely see is the semiconductor trade probably starts to fade, ironically, which probably doesn't hurt Nvidia because Nvidia has not participated in much of this run up. Nvidia has been pretty flat for quite a while now. But a lot of these memory related names, there's an ETF out there that they made, DRAM, that has collected like $30 billion in assets. I would say the best days for that theme is probably behind us. And what you're likely to see is a big rotation from these names that have put up the best returns. There's a lot of things in tech that have just been completely forgotten about, beaten up. Software names, Microsoft has been left for dead, for example. Um, and so I think there's a high probability that we're going to see a huge rotation within the market without it necessarily meaning like, oh, the stock market's going to go down 20%, because earnings are strong across the board. And it's not yet sure that, hey, is Kevin Warsh going to really, turn the screws on the economy?
Mhm.
So another way of looking at this is a really long-term chart. So um, there are these things called factors within the market. Analysts like to cut up the stock market in 1,000 different ways, and one way they do it is through factors. And these two factors are very simple. One of them is momentum. And so they are just simply taking, hey, those stocks that were up the most over the last 12 months, let's put them in an index and we'll update it, every 4 months or whatnot. The other one up here is low volatility. So we're going to take the stocks that every day move the least amount. So that are more, you're going to end up with Coca-Cola, Berkshire Hathaway in low volatility. In momentum, I put the holdings over here. It is Micron, Advanced, AMD, Broadcom, Nvidia, Tesla, Nvidia, you name them, or Intel. So what you're seeing here is this is a ratio of the two. So this is showing you how much is momentum outperforming low volatility. And then the red line here is this is just that ratio relative to its 200-day moving average. Because you'd expect momentum stocks to outperform over the long run, which they do. But at times we get these huge spikes where things just go, kind of bananas. And the extreme here is beyond what we saw back in the dot-com boom. So that gives us reason to think, hey, okay, this is probably played out a little too, it's gone too far. Not to say you got to go sell it all tomorrow, but we're not going to post a second half return like we did for the first half for companies like Micron or some of these names that have just had crazy runs. I think SanDisk is up 37x over the last 12 months. Like,
Yeah.
how are you going to replicate that? So, anyway, likely to see a rotation. And so the big thing that's obviously driving all of this, and Carl, I think I've shared these slides with you, your group a couple of times. So, this is what's driving this whole AI boom. And there's a little bit of a game of chicken that I'll talk about on the next slide, but here's just the simple math of it. And so we take all of the big tech companies and their capital expenditures each quarter. And we've got kind of a broad group. So we've got Meta, Google, Microsoft, Apple, Tesla, Amazon, and Oracle. We put this together a couple of years ago to track it. Apple admittedly never really got into the AI race. Tesla less so as well. That's all done in Elon's other company, SpaceX. But you aggregate all of their spending and you get this blue line on the left-hand side, and you can see it's just been, a moonshot. So over the last 12 months, that group has spent $510 billion on capital expenditures. Previously, they were spending it just because they saw the opportunity in AI. Now, with the one big beautiful bill, they're actually getting a tax incentive for spending it. So that's helping put some fuel on the fire. And if we look at what is expected at the end of this year, it should be about $800 billion that these companies are going to spend. So a lot more. And some firms are out there saying it's going to be about 1.2 trillion next year. And I mean, these numbers are just kind of ludicrous. But if you look on the right-hand side, what we're trying to measure is these companies' financial resources. How much could they spend if they wanted to? And so we came up with this measure of dry powder, if you will. And it is their receivables. So work they've done, money's that coming in over the next 90 days, their cash from operations. Hey, just how much money does Google generate from ad revenue in a year, sort of thing. And then how much they have cash on hand. And that comes out to about $1.65 trillion that these companies just have at their disposal. Forget about borrowing money, okay? But they are also borrowing money as well. Down here, they've got about $805 billion in debt, and that number is growing. And so as a whole, they're spending about 31% of their dry powder each year. So the moral of the story here is they can spend a lot more if they wanted to. If Google were to come out and say, hey, we're going to spend, $100 billion on data centers in 2027, they have the financial resources to do it. They can do it. Now, there's bottlenecks in the supply chain, and that's what we're seeing with memory right now. So these companies have effectively unlimited financial resources. They're just that big. Just to provide some context, if you took $805 billion, their total debt across those 7 companies, it's just 4.5% of their combined market cap. So they go issue just a little bit of stock, which Google did 2 months ago. They sold a chunk of stock to Berkshire Hathaway. They could cover all of their debt and not even blink an eye. So these companies are, just financial juggernauts. But here's the question. The stock market has, last year, every time these companies came out and announced we're spending more money, their stocks went up and everybody couldn't get enough of, hey, spend more money. This year, it's the exact opposite. When these companies come out and announce they're spending more, their stocks are going down. And so on the left-hand side, we have the drawdown for each of these stocks. How far are they from their all-time high? All of these stocks, for the most part, are underperforming the tech sector by a pretty wide margin because investors are looking for proof that they're going to get, or there's going to be a return on investment for all of this capital expenditures that they're doing. Now, these CEOs, by and large, call the shots within each of these companies. But at some point, I mean, there is a board of directors that's elected by the shareholders. At some point, and actually, sorry, I should have updated this. Oracle's down, I think, about 57% from its all-time high. But at some point, the shareholders get upset. They go to the board, and the board goes to Larry Ellison and says, "Cut it off, man. We're not doing this anymore." And so that's the mechanism of how this AI spending boom is going to likely stop, or at least get reined in a little bit. One of the CEOs of these companies is going to come out and say, all right, we're not playing anymore. And that likely the result of that will be all those semiconductor names that are going through the moon. All of a sudden, those things probably reprice lower. And those things that have not done well likely start to recover. So that's kind of the big rotation that I think we will see. We have earnings starting. We're just starting this week. Most of these names don't report for a few weeks, but we'll be listening to the Q&A during their earnings calls to see if there's any hints of CapEx spending of this number kind of plateauing at somewhere up here. It's not going to go back down. These data centers constantly need to be refreshed with new technology. Carl, you mentioned NVIDIA. They've got the next 3 chips already lined up with greater capabilities. It's not going to go back down, but it'll probably level off somewhere. And we've seen this before. You go back to 2023, CapEx spending leveled off. 2019, it leveled off. So, this happens. It's just it happens to be very acute on the CapEx spending. Okay. One other thing that, as everybody's talking about SpaceX's IPO or Micron or, AI data centers, what a lot of folks don't realize that international stocks have actually been outperforming for the last 18 months. So this is the cumulative performance over the last 5 years of the All Country World Index, excluding the US versus the US. And we peaked down here in January of 2025. It's been a volatile relationship. But if I could stretch this chart back further, this would be a 15-year trend, uninterrupted, that went all the way back to the financial crisis. And what has happened internationally, and I have a slide on it, but I didn't include it in here. When Trump announced that he was going to, well, he threatened to leave NATO, it really lit a fire under European leaders' feet, whatever, because they have launched a number of fiscal programs, all financed by larger deficits, to rebuild their infrastructure and military industrial complex for one day having to stand on their own against Russia. And they're putting hundreds and hundreds of billions of dollars. The last number I saw was, I think it was $800 billion that they're committed to spend. Their goal is to be military independent by 2030. And so that has caused European country indices, European equities to perform really well. And the other thing on the right-hand side, there's been this odd persistence of, I shouldn't say it's odd, it's rational, of international value stocks outperforming international growth stocks. And the thing is, if you want to own a growth stock, you come to the US, right? You want our tech sector, you want the Mag 7, you want those names. If you want to buy a value stock that yields 4% in a dividend, you won't find that in the US. We have hardly anything that yields 4%, maybe Philip Morris or a tobacco company. But if you go to Europe or international markets, you can get attractively valued value stocks that pay healthy dividends. And so what we've seen is this bifurcation. If you're looking for growth, you go pile into the US. If you're looking for value, you go pile into international markets. And so we have a bit of an overweight in international value, which has done well. And it's a trend that I think continues because a lot of the fiscal spending that's going on in Europe is all value oriented, right? They're not giving money to Spotify. They're giving money to defense companies and industrial names and things of that sort. So just to give you a valuation kind of view, also which kind of supportive of international equity. So we're up here in the top left where, US equity markets trading at, 21 times forward earnings, somewhere in that ballpark. Over the last 12 months, over the last 12 months, whatever, up 24%. look at a lot of these European countries, their valuations are, 30, 40, 50% lower than where we are. I mean, look at Poland, up 40%, Greece up 38%. Carl, you were helping out their economy on your vacation. Um,
Sure.
Austria, these places that you're like, oh, that's odd. Like, but there is a huge boom going on in Europe. It's still in its early stages because it's just started last year. But there is a lot of optimism around uh, all of this deficit spending that they're putting out there across Europe, which is obviously helping the earnings for international equities as well. Okay, so going forward, so we talked about the first half of the year. What was the big question was, hey, how fast is economic growth going to accelerate or not? We've certainly seen a huge acceleration. Certainly more in corporate America than maybe in the labor market. Um, but the big questions for the second half of the year is, okay, how hawkish or dovish is Kevin Warsh? And let me just advocate that this is a working little mental model that our team is working on. Don't think this is prescriptive. This is our team's kind of latest kind of way of just visualizing the different variables that are out there. So is AI capex spending going to be higher or lower than expected? And is the Fed going to be more hawkish or dovish than the market currently expects? We don't have we're not betting on one of these boxes at the moment. We're going to get earnings from all the big hyperscalers here in a couple weeks. We have an FOMC meeting on July 29th. We're waiting to kind of for these couple of events to start to maybe think about leaning portfolios into one of these areas. Now, think through this for a second. If all of the Mag 7 names come out and they say, hey, we're spending double next year, we'd be, up here in this box. And if the Fed comes out and says, hey, we're going to be super dovish, we're going to cut rates,
Mhm.
maybe Kevin Warsh does listen to Trump and hey, we're going to cut rates 100 basis points. Yeah, okay, that's going to certainly support those things that have already been working. Semiconductors, tech hardware names, emerging markets have been on an absolute tear, mainly because of South Korea. They have the memory names there. Um, on the other hand, though, let's say capex expectations come in lower than expected, but the Fed is dovish. That's probably good for the overall market, right? Overall market's going to do better on lower rates, but it's probably not great for those semiconductor names. But it's probably good for software, the Mag 7 names that they're the ones that are spending the money. If they stop spending, their stocks are likely going to benefit. So there's going to be a different group that's going to perform well there. And like I said, we just threw some things in. We're not, this is not a prescription. We're just, kind of pointing in a direction. On the other hand, let's go to the bottom right box. If capex intentions are lower, hey, we're not spending as much. Bad for semis. Carl, to your point, can the market go up without them? They can, but if the Fed's also very hawkish, that's probably going to be, hey, maybe we need to start thinking about owning some consumer staple names or, but putting on a little bit more defense. I don't think it's not the time to start making these adjustments. We're going to learn a little bit more over the next couple of weeks, and we might see some, the need to make some adjustments. But I think the moral of the story is, hey, things are really good in corporate America now. We're probably getting close to the peak of how good they will be in terms of reported earnings and things. Going forward, 12 months from now, so July of next year, maybe we need to be a little bit more cautious or rein in our expectations between now and then. Doesn't mean you got to do something today or next month, but just be on the lookout that, hey, probably all of the easy gains that we've had, are probably behind us. And now it's going to become a little bit more, you're going to have to be a little bit more selective on what we own, and make sure that we don't, get too excited about buying Micron when it pulls back 20% because we think it's going to go another 80. Well, maybe it's going to go down another 30, right? And just be a little more, just rein in our expectations a little bit. Let me see, what else do I have on here? That's sort of a summary of kind of what we talked about. Anyway, Carl, I don't know any stop questions that were at, I guess, have been
Yeah,
running
I'll throw.
15 minutes.
I think that next slide actually addressed a one of them, which was just I get questions all the time around, the Iran conflict as if things start to get a little bit worse again, we start bombing more. But it seems like the market is just kind of ignoring it at this point and just moving past it. Is that, and I assume that's your general
Yeah,
viewpoint that from a market perspective, that's not going to be an issue.
that 100%. And you could I don't know, this might be not be a good example, but if you think back to COVID, the initial shock of like, oh my gosh, we're shutting down the economy. Everybody was checking the case numbers, like how many cases there were. Everybody was checking a website, and then we went through some like peaks and then some resurgences, and there were still huge numbers of cases into 2021, and um, after the initial shock, the market isn't surprised the second time it comes around. This is the same thing with oil. When first the attacks happened, yes, oil shot higher, market reacted negatively. Um, the second time around, like we just had over this past weekend, the market didn't even blink. At least the equity market didn't blink. Oil has gone up in price, but we've already come down a long ways. And yes, the market is moved on to the next thing. So it's unfortunate that that's happening. It's going to be, I'm sure we're going to get it resolved. But fortunately, certainly for domestically for us, the U.S. is now the largest energy producer in the world. So we don't produce every type of oil that we need, but we are certainly in a much better place than many other countries around the world when it comes to oil. And so our equity markets just kind of shrug it off. And okay, it was a thing back in March that was because it was a surprise. But when you try to surprise the market a second time with the same trick, yeah, it doesn't bite.
So are there any other things that you guys are tracking that could be concerning? I mean, any sort of, call it political or geopolitical, future issues, or is it just, I guess, in the more immediate time frame, it's let's track Wash, the Fed chair, and just overall spend from the hyperscalers, and then maybe later in the year you start to think a little bit more, politically, or how are you guys thinking about some of those things?
Um, well, so okay, well let's touch on politically. So midterms, um, I haven't checked what the current betting markets are, the prediction markets, but they were heavily in favor of the House going to Democrats. Um, and look, that's actually not a bad thing. The stock market likes gridlock. So if policymakers can't pass policy because they're too busy bickering with each other, stock market loves that. Corporations understand what the rules are, what the policies are, what tax policy is, and we can move forward. So I would expect that the House is likely to flip, um, and that would be a positive thing. Now, historically, the third quarter in a midterm election year is usually not very strong because the market is worried about, hey, which way is the election going to go? And it's usually a little soft until we get to the first week of October. And then October, it must be because pollsters are starting to get a little better read on who's likely to win. The market starts to anticipate, and the first week of October, the market usually bottoms and starts to head higher. And the fourth quarter of a midterm year is extremely strong historically. Now we've had a great first half of the year, so maybe we don't get a huge run up, and that's just seasonality. We have to see what happens with Warsh and the AI trade and all that. So I think that's the way to think about midterms. I think a split Congress for the next 2 years, split Congress is what we all want because we want gridlock. Market likes that. Other things that are percolating in the background, I would say that we're keeping an eye on. So look, I would say we use this expression. Everybody knows Dunkin' Donuts. America runs on Dunkin' is their tagline. Well, we got to use America runs on credit is what really drives things. And so at the moment, credit markets have been extremely supportive of economic growth. But not all companies can go tap the market. Not all companies are Google or Microsoft, and they could raise $25 billion at a drop of a hat. There are pockets of weakness within credit, sort of similar to the labor market, where hey, there are some industries that are doing good and some that aren't. Um, we've never had a downturn in the economy without credit markets becoming more challenging for corporations to borrow. Right now, everything looks, just fine. There are a couple pockets of weakness, but we always keep a close eye on credit markets. Um, so I think there's, something to keep an eye on there, certainly. No red flags at the moment, but there's a couple of little embers burning on the side, perhaps. Other than that, um, no, I mean, I think it's really these two questions. The Fed is going to be a big one. What does Kevin Warsh do? How quickly does he want to get back to 2%? Um, and look, for stock investors, elevated inflation is not, it has not been a bad thing. We don't want inflation running to 7 or 8, but inflation running at 3 has been positive. That means prices are going up, corporations or revenue is going up, their earnings are going up, and so that's a positive. If he comes out and says, I want to get to 2% within the next 12 months, um, we're going to have some, we're going to give back some of our gains. Not like, hey, the economy is going to fall apart. Most of the economy can absolutely handle higher rates. It's just the stock market may wobble a little bit. And it's not, it's not going to be some horrific bear market. It will be, hey, we have a 6-week pullback. That was painful, but the market adjusts to it.
And from the conversation too, I mean, it seems like it most likely provides a good opportunity for a bounce back. So for some folks that, maybe been waiting on the sidelines, it sounds like there could be a potential opportunity. And then for folks that have been invested, I mean, you just have to ride the wave in the near term. And, obviously, myself and SIA will continue to, keep you guys apprised of any change in the market, or if we see something that's alarming. I think this really sets the stage for the upcoming quarter. So for folks on the call, if you guys do have any questions for myself, for Phil, certainly as changes happen, let us know. That's why we're here, and we'll look forward to the upcoming quarter. And as changes happen, if there's anything that we need to make big strategic moves within the portfolio, we'll certainly keep everyone apprised of that as well. So, with that, we're at the top of the hour. So once again, thanks, Phil, for the wealth of information. And then look forward to seeing you, later on in the year.
Absolutely. My pleasure. Thank you.
All right. Thanks, everyone, for joining today. Have a great day.